And as you heard, this meeting is being recorded. And we have some folks coming in already. So we'll wait a few minutes for everyone to enter the room, and then we'll get started here.
Perfect.
Good stuff.
Thank you to everybody that is joining us right on time, slightly early. We're going to get started right at about 12:30. So we are looking forward to it. Okay, it is 12:30. Good afternoon, everybody, and welcome to our webinar today. My name is Mary Verano, and I am the marketing coordinator at Corrigan Krause. I will be guiding our discussion today. Thank you for taking the time today on your Tuesday to join us as we dive into cryptocurrency. Our goal today is that you will walk away with a better understanding of exactly what cryptocurrency is, how to use it, and what role it can play, if any, in your overall financial plan. We have some incredible speakers today. We have Gwyn and Tim from Corrigan Krause and Brian from CKE Financial. I'll have Gwyn, Tim, and Brian each give a brief introduction, and then we'll go over a couple housekeeping items before jumping into our discussion today. So Gwyn, why don't you take it away?
Thanks, Mary, for that great introduction. As she said, my name is Gwyn Broski. I'm a tax manager here at Corrigan Krause, and I got interested in the cryptocurrency realm probably about 2 years ago, more out of like necessity for our firm, as some of our clients started to receive some letters that we'll discuss a little bit later, regarding some of their transactions that they may or may not have had. And it was a growing opportunity that we could use to better assist our clients. Corrigan Krause is a firm. We're located right here in Northeast Ohio. We have 3 office locations on the east, west, and south side of Cleveland. We're a regional firm. We help with our clients with any financial issues they may be having, help identify their goals, what their objectives are, and provide solutions. We have a number of niches that we focus in besides the cryptocurrency. We have construction, manufacturing, healthcare, and the professional services.
Great, thank you, Gwyn. All right, Tim, how about you introduce yourself?
Yeah, so my name's Tim Monroe. I'm a senior tax associate here at Corrigan Krause. I've been with the firm for about a year now. My background is small, closely held businesses and kind of working with the owners, tax planning, a small bit of tax resolution, and like Gwen, in the last couple of years, became really fascinated with the cryptocurrency area. And I think that, and we'll get into this later, but I think blockchain and the whole area has a lot of future use to it. And I think it's really interesting, and I hope you guys do too. So I'm really enjoying talking about this today.
Great. Thank you, Tim. And Brian.
Yes, thank you, Mary, and thanks for everyone for joining us today. I think we're all pretty excited here to talk about cryptocurrency and how it fits into your overall financial plan. And as Mary indicated, I'm with CKE Financial Services, and we're an independent office of Raymond James in Strongsville, Ohio. And I got into financial planning, gosh, way back in 2002, and it was really as a result of growing up as a child, being one of 10 kids, budgeting and working hard, or a good work ethic, were really things that were instilled in us, not so much by choice, but out of necessity. And as I got a little bit older, the idea of investing money and growing someone's wealth, or helping grow someone's wealth, was really appealing to me. So right out of school, I got into financial planning, and 20 years later, here I am, just as happy and as excited as I was back then to help clients protect and grow their overall wealth. And the cryptocurrency is a part of that. It's changed a lot over the last few years, and I'm a part of this because of that. And more financial planning clients have come to me over the past year or so and asked me about crypto and how it works and how it fits into their overall financial plan. So we'll circle back to that in my part.
Great. All right. Thank you, everyone. Before we get started, a few housekeeping items. We'd like this to be an interactive discussion today. So you can either use the chat feature or the Q&A section to post any questions that you might have, anything you want more clarification on. Let us know. This is obviously happening in real time, so I can help jump in and ask Tim, Gwen, or Brian any questions that you might have. If we do start running long on the questions, keep putting your questions in there, and what we'll do is release a kind of Q&A piece later on, and we'll post it on our social media, and you'll be able to download that later on. So this recording and PowerPoint will be distributed to all of our attendees and will be available for download. So watch our social media feeds, particularly LinkedIn, and we'll have all of the documentation ready to go for you to download and share with anybody that you think might benefit from our information today. If you'd like this type of important information sent directly to your inbox, email info@corrigankrause.com, and we will add you to our newsletter list. We send out a couple emails a month, and that helps keep everybody up to date on the most important news, we think, to our clients. Okay. To kick off our discussion, Tim is going to walk us through some of the new vocabulary, probably not new to everybody, but new to some of us, that we will need to know so we understand what exactly we're talking about in the realm of cryptocurrency. So, Tim, take it away.
Awesome. Thank you, Mary. Yeah, so let's go over some brief definitions, and I think it'll really help guide the conversation as Gwen's speaking and Brian kind of gets into the financial impact of it. But essentially, and first thing I want to note is, I know Bitcoin is the most popular cryptocurrency, but it's important to note that Bitcoin and cryptocurrency are not synonymous. Bitcoin is a subset of cryptocurrency. So a cryptocurrency is a virtual currency which is secured by cryptography, and it uses blockchain technology to manage and record the transactions and make sure there's no duplicate spending, and every transaction is recorded on the blockchain and distributed to all the users. So I guess just as a background, what people ask, like, well, why don't you just use cash or a traditional bank? And the goal of cryptocurrency was to form a type of digital cash that was decentralized and didn't go through a financial institution. So if I wanted to send 1 Bitcoin to Gwen, I don't have to go to Chase Bank and have Chase Bank tap on Wells Fargo, and eventually in 3 to 5 days, something's deposited into Gwen's account. This is something I can send it to her. 10 minutes goes by, the transaction gets approved, and Gwen has her Bitcoin. And to kind of expand on that a little bit, because what really drives the security and the importance of cryptocurrency is this idea of blockchain technology. And blockchain technology is a subset of distributed ledger technology, which means there's no centralized record keeper. Everybody has the records. And although you can't identify the names to whose specific public keys they are, the records on the blockchain are permanent and they can never be changed. So think of the blockchain as almost like a record book. Every time there's new transactions that are approved, the block gets added to the chain, it's distributed to everybody, and it goes on and on. And just another, what actually drives the security in the process, and we'll kind of keep this to how there's two types of ways to process cryptocurrency, and it's called proof of work and proof of stake. And Bitcoin is actually a proof of work cryptocurrency. So the way that transactions are approved and security is ensured is through this idea of Bitcoin mining. And essentially, Bitcoin mining is when people approve transactions on the blockchain, and that's done by these high-power computers that essentially, as a transaction occurs, it's encrypted by crypto encryption, and there needs to be a miner that decrypts that transaction and then allows the other recipient to decrypt it with their public key, and ultimately that's what moves the funds from one account to another. But it's the Bitcoin mining that really keeps the blockchain safe and secure. And that's how new Bitcoin are added as part of a transaction fee. When a transaction is approved, the miner gets, it changes every 4 years, but I believe now the rate is 3.5 Bitcoin per transaction. So every time a transaction is approved by the miner does get, that's their stake in the game, they get a fee. And just to follow that up, these are two important, at least from our standpoint, these are two important definitions. These are both, when it comes to taxable events on the blockchain, these are two ways that it happens. And what a fork is, and the most notable fork, in my opinion, would be the Bitcoin to Bitcoin Cash fork, which happened in late 2017. And essentially what a fork is the community and the miners agree, hey, there's a way that we can improve the blockchain. In this sense, the Bitcoin Cash blocks were increased in size to produce faster transaction speed and to lower transaction costs. So essentially, it's non-retroactive, and at a specific, let's call it block 1 million, there's a fork in the chain. They all agree, we want to create this new currency. We want it run off the Bitcoin blockchain. However, it's not going to play by the same rules. And what happens at that point is the holders of the original cryptocurrency on the original block, they get a coin for coin up of the new crypto. So the way that this happened was, let's say I had 1 Bitcoin at the fork date. When the fork occurred, they would say, hey, Tim, we built a fork off your blockchain. We need to give you a coin. I give you 1 Bitcoin Cash coin for, and then you get to keep your Bitcoin, your original Bitcoin. And then just from a tax standpoint, that's income on receipt, not declaration. So in this circumstance, the fork was declared in late 2017, but the funds weren't distributed until 2018. That would be a taxable event in 2018. And this new form of marketing almost is the practice of a cryptocurrency airdrop. And what that is let's say there's a new cryptocurrency that's trying to become more prominent. They believe they have a very good use case, and they're trying to distribute and get their cryptocurrency out there so new users can use the cryptocurrency. And opposed to spending marketing fees and trying to figure out how to get people to use their coins, the company just says, hey, let's get these coins into circulation, and the users will use them. And hopefully there's like a word of mouth thing where if this becomes a more prominent source of crypto, people have it, they can use it, and then the company benefits by those transaction fees. But essentially an airdrop is the receipt of new coins. Again, just like the fork, income on receipt, not at declaration.
Okay. Now, do we feel like we know what we're talking about? I feel like we know what we're talking about. So Tim, can you tell us how we are actually going to buy cryptocurrency and use cryptocurrency?
Yeah, so there's the main way to acquire crypto is to go through a brokerage. There's many prominent: Coinbase, Binance, Kraken. Those are the 3 big specifically cryptocurrency brokerages. Also, a very popular brokerage that a lot of a lot of retail investors use is what's called Robinhood. And Robinhood doesn't offer the magnitude or even the lower level cryptocurrencies that some of these other exchanges have. They do a very good job of allowing the retail user to get some sort of exposure by staying within their comfort level. So Robinhood, if you want to just dip your toe in, I'd recommend kind of like a Robinhood situation. Also, some new ways that you can buy crypto, which is within the last couple months, is these payment processing services such as Venmo, PayPal, and Cash App. They actually have now a few coins you're able to buy. You can't send them, but you can buy and hold them in their app. So again, just a really easy way, no transaction fees. You can buy your crypto and just kind of get a feel for it, see how it works. And to kind of piggyback on that, there's two ways to store your crypto. What I just described above in the brokerages and then these online digital wallets is called hot storage. And that's your crypto is online, it's easily accessible. You can send it, you can withdraw it, you can move it as you please. The other concept, and these are for people who kind of have a long-term view on Bitcoin or any sort of cryptocurrency really, and they just want the most secure way to hold their cryptocurrency, and that's cold storage. And essentially, they're types of digital ledgers, and they're kind of like a USB, or you can use an old monitor or an old hard drive, but you can keep your cryptocurrency and then unplug that. You could take it out of the computer and you have it in your hand. Nobody can access it. It is the most secure way to store your cryptocurrency. And that's very popular among people who want to hold for a long period of time. And then kind of going on that as to how people are using it right now, largely speculative investment. I think that, as you guys know, there's a lot of news that's come out in crypto. People have made a lot of money in a short time frame. People finding coins from back in 2010 that they thought were worthless, and now they're worth millions of dollars. And people think that there's a use case in the future. So this has been an absolutely active market for people to buy crypto. Another new circumstance that happened is down in El Salvador. The El Salvadorians were being hurt by hyperinflation and their currency. They use the American dollar, and they haven't gotten the government stimulus that the United States has. So their dollar is not worth as much as it used to be. And now the president of El Salvador said, hey, how can we stop the slide? And how can we get more people who maybe don't have access to a traditional financial institution a way to carry cash? And that's why now, I think starting towards the third quarter, people in El Salvador will be able to use Bitcoin as legal tender. And then another big event that recently happened, Trevor Lawrence out of Clemson, one of the most highly touted NFL prospects, probably since Andrew Luck or Peyton Manning, signed a partnership with Blockfolio, which is essentially an online savings account for Bitcoin. You could put your Bitcoin or your Ethereum or any type of types of cryptocurrency that they support, and they're able to store it and you earn interest on that. So Trevor actually opted to receive his NFL signing bonus in Ethereum, which is incredibly optimistic for the cryptocurrency space, because you would think that he would have gotten Bitcoin, the most prominent, the most dominant cryptocurrency. So the fact that he got this newer type of crypto, a lesser known, still very popular, is very encouraging for the space going forward. So there's definitely some recent events, and it's like every day there's something to keep an eye on.
Certainly is. And before we move on from Tim here, we did have a question come in about ownership, hot storage versus cold storage. The question is, do you fully own your cryptocurrency when you're using a brokerage like Robinhood, so the hot storage? And depending on that case, is there a way to transfer from hot storage to cold storage? That's
an excellent question. So Robinhood, you do not actually own the cryptocurrency. That's a very good question. Robinhood, and unfortunately, I'm not the one to ask how that actually works, but I do know when you own cryptocurrency on an online wallet such as Coinbase or Binance, you have your private keys and you have your public key, and you're able, and to answer your second question, you can, when you actually have the keys to your crypto, you can move it between hot storage and cold storage, and you can move it as you please. However, with, a Cash App, Venmo, Robinhood, you own the rights to the crypto, but you have no digital keys and you can't withdraw it from the brokerage. It has to be left on.
So if you have crypto with Robinhood, it's staying on Robinhood. You're not switching it over. So moving forward, you would have to do something different to get it onto cold storage.
To get back to your cash, you would have to have a taxable event. You'd have to sell your Bitcoin for fiat currency and withdraw your cash that way. You couldn't just pull, if you owned a Bitcoin on Robinhood, you couldn't just pull your Bitcoin off of Robinhood.
Got it. And I don't think I could have asked for a better transition to Gwyn and our tax implications. So Gwyn, now that we understand how to utilize cryptocurrency, how can we make sure that we are prepared for tax season?
Right. Thanks, Mary and Tim. I mean, Tim, that was a great explanation of a lot of key terms that are being thrown around these days. And it's important that, I know a lot of people over the past year or so were kind of sitting at home and had gotten on Robinhood and started doing day trading. And, because of COVID, people were out of the office and they got, into Dogecoin. We started hearing a lot about that. So just some things to think about for you first-time investors that are out there who maybe during 2020 started dabbling in crypto and started selling it and sending it to your friends. What you need to be aware of as we go into tax season and what you have to report so you don't get a nice letter from our friends at the Internal Revenue Service. So some key things to think about. So there's the wash sale rules, which do not apply to cryptocurrency because crypto is taxed as property. It's not treated the same as like your stocks and equities are. So what the wash sale rules are that impact the equities is, if an investor sells a security at a loss within 30 days, kind of before or after that transaction, they can't go out and get substantially the same investment. So that loss becomes a wash. With crypto, if you have some substantial money in it, it can be a planning tool that you could use with your clients because you could essentially sell it at a loss. If you still want to be in it and think it's going to go back up in the relative near future, after you make that sale, you get your cash, you turn around and buy it again. Well, now you're allowed to recognize that loss. It is subject to the capital loss rules. So if you don't have any other capital gains to offset that, the max you can recognize on your return is $3,000. Anything over that gets carried forward. You're also not allowed to do any Section 1031 like-kind exchanges. Those are only for real property after there was the tax law change, which made that effective as of January 1st of 18. And the IRS just recently put out a memorandum on this, kind of clarifying this for anybody who might have tried to do a like-kind exchange before January 1st of 18, that they're still disallowed. So if you have any clients that maybe had did this, or you did this yourself, where you were doing a Bitcoin to an Ethereum transaction and you didn't want to pick up a gain, just know that the IRS has disallowed them and that you kind of could be at risk for a letter or an audit potentially. So just be aware of that. But to calculate a gain or a loss when you sell your currency for like US dollars, you just calculate the difference between your adjusted basis and the currency and the amount you exchange. Very similar to what we do when you sell a share of Apple. What you paid for it versus what you received in gross proceeds is kind of your gain or loss in the middle. But what you have to be cautious about is if you're doing a lot of trading and selling and buying of different currencies, you have to keep very detailed records. What we've seen this past tax year is that a lot of these brokerage firms are charging fees for their record keeping services in order for them to produce, the documentation you need to do your return. A lot of clients were giving us just their transaction history, but that doesn't really tell us, we still need cost basis. We still need to know what fees were associated with those transactions so we can make sure we're properly calculating basis and what your proceeds are. So what we've seen this past year is a lot of third-party companies out there have started up and started partnering with the brokerage firms to do the tracking for you. Some of them, you can get it free up to so many transactions. So if you have under like 25 transactions, you can get it for free. Some of them are doing 50. It all just sort of depends on what third party you want to use. Those tracking softwares are really nice because at the end of the year, you can just get all your documentation. It'll have all your sales dates and your proceeds. It'll even produce, the Schedule D forms that your accountant, CPA person will need. And it also gives us the Form 8949 for your return as well. So, there's a lot of ways you can properly document it. If you're only, you bought one Bitcoin and you're going to sit on it and then you're just going to sell that one, you could probably keep those records yourself. If you're getting into a little more heavier trading, then you're going to probably want to invest in one of these coin trackers just to save yourself, a headache at year end trying to figure this all out, when your CPA calls and asks for cost basis. A lot like what Tim said, there's a lot going on. In the cryptocurrency space where people are getting, signing bonuses, they're being paid in crypto, a lot of retail accepting it. We're going to discuss more of that stuff. We have another webinar planned to get into more advanced topics on how, there's subcontractors and employees being paid. So we're going to cover that in our Crypto 201 webinar.
A good shout out for a couple months from now. We did have another question for Gwyn. Well, a question come in for Gwyn here. So if someone just got into crypto and really did not think super forward about tax season 2022, what can they do what can they do right now to ensure that they're getting the information collected now? Is it based on the brokerage they're using? Is it like what can they do now to get their paperwork in order?
Sure. So I believe a lot of the third-party coin tracking softwares, and Tim, feel free to join in on this, they can go back retroactively to get those records for you. So they can go back through your history and kind of calculate what your basis is, what the proceeds were, and provide those at the year end. Because I know a lot of our clients were running into that situation where they just basically gave us a transaction history, and we kind of had to go back and forth with them to get more information, and they were able to utilize those coin tracking softwares and get the reports that we need.
Okay, so ultimately it's never too late to get your information that you need.
Correct.
All right, great. And we had another question come in for Gwyn. How do we measure the cost basis? Is it in net of fees? Is there something more complicated? How are you going to actually measure the cost basis?
Sure. So the cost basis is determined just like you would for an equity. So it's what you paid for plus any fees. So if I bought half a Bitcoin for $1,000 and I had to pay a commission to get it of $25, my basis is now $1,025.
Exactly.
Got it. Okay. Another question here. What about staking rewards and mining rewards? Do I have to report those if I don't sell them?
I'll say this is a very interesting actually question, and I'm happy that we got it. And I think this specific question actually leads to our Crypto 201 a lot better than this format. However, okay. I can just to do my best to answer your question right now. I haven't seen too much on crypto. So crypto staking is essentially you put your crypto out there for the network to drive with it, and then they pay you a fee and interest. It's actually a part of your coin. So if I staked Ethereum, I would earn Ethereum rewards based on how long I've had it in there, how much I have in there. And we'll cover this more on Crypto 201. I've never seen a 1099 issued by any exchange that shows that you're staking rewards. However, it's ordinary income as you receive it. It's not a capital gain. It's something that it's taxed much like interest.
Got it. Thank you. All right. Well, moving on. Brian, cryptocurrency is in the news quite a bit, as we keep saying, often because of the volatility. And since you're the financial planner, volatility is a very big part of your world. So is there actually a place for cryptocurrency in someone's financial plan, particularly if their financial plan is a long one?
Yeah, thanks, Mary, and thanks, Tim and Gwyn. You guys have done a great job so far, and some really good questions. So I'm happy that Tim's on here to answer some of those instead of me. So thanks again. But before I answer your question, Mary, I wanted to start with something a little bit more fun or interesting. So the pizza diagram up there. For anybody that's interested, you can Google the Bitcoin Pizza Index, because you'll see this pizza diagram. What this is representing is the very first transaction of Bitcoin about 11 years ago, where a person bought 2 pizzas for 10,000 Bitcoins, which at the time were valued at $41. So the Bitcoin Pizza Index says, how much did those 2 pizzas cost in today's Bitcoin value? So 10,000 Bitcoins for the 2 pizzas most recently equated to about $379 million for the 2 pizzas. So when you talk about inflation or the cost of something going up, whether it's the pizzas or the currency, I mean, it's just grown astronomically. So the kind of the end story with this is the guy that got the pizzas was happy he got the pizzas and is happy to be a part of the first transaction. He says he does not miss the $380 million that he would have had today. And then the guy that got the 10,000 Bitcoin, well, he did not keep all of those either. He did say that he took his girlfriend on a vacation and they had a good time, but it's not as though he's $380 million richer either. So all good though. That's the Bitcoin Pizza Index, and the Bitcoin Pizza Day is May 22nd of each year. So I thought that was kind of interesting. But back to your question, Mary, how does it fit into the overall financial plan? And so, as I mentioned, when we kicked this off, more and more people, especially when cryptocurrencies were valued higher, a lot of questions coming in from clients on whether they should be investing or how much they should be investing. So the very first thing is, when it comes to a financial plan or having a plan, Dogecoin to the moon is not a plan. That's fun to talk about, fun to say. Elon Musk pumped that up. That's great. But that is not a plan. For most people that are interested in cryptocurrencies, it's okay to invest some of their investable assets in a cryptocurrency. I believe that there's 2 types of people right now, and one is kind of the crypto curious person that might be watching right now thinking, hey, I'd like to buy some cryptocurrency, or somebody saying, hey, Dogecoin's only 20 cents right now, maybe I should get in. So crypto curious people, I would say 1 to 3% of their investable assets is an okay investment. So they've got to realize though that their 1 to 3% may dramatically fluctuate with the volatility. But again, that's just a small investment. And then somebody that is more of a crypto expert. So I would say Tim fits into this category. 3 to 5% of their assets is okay. Again, as long as they know that there can be extreme volatility. If they know that and they're willing to accept that, that's okay. But again, this is really just an alternative investment as a part of a person's overall financial plan. So, not to get too boring with it, but the reality is that when we meet with a client or a new client, we either have already run a financial plan or we're going to run a financial plan. And this is simply, again, an alternative investment that we include in the plan. And overall, the plan still has to help someone reach their goals and help them grow their wealth, and as we help them protect their wealth. So there is a place for it within a portfolio. Even with the most aggressive investors, I like to make sure that they understand what the risks are with cryptocurrencies, and definitely try to keep people with the appropriate amount of crypto. And the reality is, as I look back, being in the business as long as I have, I look back to 2008 with the Great Recession. One of my takeaways from 2008 was the idea of diversifying some outside of the market. So going back to 2009, 10, 11, 12, I think that more people started seeing value in investing in other things as well, keeping their 401ks, IRAs invested, but then maybe investing in some real estate or some gold or some other collectibles, but diversifying out of the stock market some. And I see this as a similar sort of play where somebody says, hey, I'm interested in diversifying out of the market a little bit is okay. I do think, though, beyond the overall financial plan, that I stress and continue to stress with people to make sure that they have a plan and they're sticking to it, and we update it. But all of that being said, the one of the keys for me as the financial advisor is having the relationship with people like Gwyn and Tim to make sure that when I've got a client that is buying crypto or selling crypto, that we work with our CPA to make sure that we're taking the right steps. Because the last thing I want for one of my clients that is been buying and selling crypto is for them to make a mistake on their taxes and get the letter that Gwyn referenced, or get in any kind of trouble. My job is helping to protect my clients, helping them grow their net worth, helping them protect everything that they've worked so hard for. So again, I think my part is the normal, let's make sure we have a plan and diversifying asset allocation, and crypto can be a part of it.
That's good. I think you probably broke a few hearts with Dogecoin maybe not going to the moon, but who's to say? We did have another question come in. The question is, where does the value of crypto come from? Is it only valuable because you might be able to sell it to somebody later? Which I think is almost a philosophical question about value in general, but in this case, we'll just keep it to cryptocurrency.
Yeah.
And I can kind of jump on that one. And Mary, it's funny, you gave a perfect explanation. It's what's the value of the US dollar? What's the value?
Right.
I think a more correlating value would be what's the value of gold? Gold has a high value because even if you wanted to get more out of the earth, it's very hard to get out of the earth. So when there's an increase in demand, the supply has a very hard time catching up with it. And this isn't how all cryptocurrencies work. Many have larger circulating supplies than Bitcoin, which is 21 million. However, to keep in sense, it's what's the value that we give it? It's hard to determine that. There's, it's not FDIC regulated, or there's no, it's harder to it's not tangible. You can't hold it. It's not like a piece of art or even like jewelry or like gold. So it's really the value that we derive on it.
That's great. We actually have a question for Brian. Brian, for clients who are speculative investors, who would direct exposure to cryptos make sense? Or should we focus those clients toward companies like Grayscale that are set up as open-ended crypto trusts?
I think there could be a place for a speculative investor. I think there could be a place for both. I think that there's probably more volatility with directly owning the cryptos, but I think there is a piece of the portfolio that can go directly into crypto, and or a piece that can go into crypto related stocks that are traded. So I'd say a place for both, potentially.
And do you think that is more rooted in how much volatility can a particular investor stomach? Like if they're not ready to ride the high and low waves, maybe something like Grayscale is more appropriate? Or
I think it could be a part of it. I think too, owning a company or a stock like that can open a person's eyes to what is going on, and it'll maybe get them more plugged into the crypto market. So then they're paying a little bit more attention because they own a Grayscale. They're paying more attention to the crypto market.
Got it. All right. Well, switching gears a little bit, Tim, can you talk about how cryptocurrency is not quite as anonymous as folks would have thought even just a few months ago?
Yes, that's a great segue. Is people, one of the biggest downsides that a lot of people that maybe unaware, maybe they have a negative persona towards cryptocurrency is, oh, this is the money of terrorists. It's totally unidentifiable. You can't trace it. Now as we're talking about the Colonial Pipeline, which is the largest refined oil distributor in the United States, even they could succumb to something like this. And essentially what happened was, for those of you, I'm sure most people know what a ransomware attack is, but just kind of a refresher is, hackers get into your system, they encrypt your data, they encrypt what they want, and then they demand a fee to give you the key, which unlocks your data. And Colonial Pipeline succumbed to this attack, and they paid the fee. They paid 4.4 million or upwards of $4 million in Bitcoin to these Russian ransomware people. And it's really interesting how the FBI, and as maybe you guys have heard, maybe not, the FBI was able to recover about $2 million of the Bitcoin ransom. And what scared a lot of people right away was, hey, if the FBI is able to get into it and hack it, when will the hackers be able to get into my Bitcoin? And that's a large misconception as to how this happened, because what happened is the FBI was able to identify a large Bitcoin transaction to a specific address on the public ledger. And they said, wow, this seems a little strange. And it was a little sloppiness on the hackers where the FBI was able to track down the public address, and they found the server or whatever platform that the hackers were using to, with their technology and where they held their Bitcoin credentials. And it was sloppy protection of their private keys. The FBI never hacked the Bitcoin private keys of the hacker. They hacked the server, were able to access the private keys on the server. And that's how they were able to unlock it and get back the Bitcoin. And don't quote, I don't know the exact measure of it, but I remember reading that approximately you would have to win the same odds to win 6 Powerballs in a row is the same odds as hacking somebody's private key associated with a public key. So it's the most secure form of cash that we've ever seen.
Okay, so it's not entirely anonymous, but it would take some effort, is what we're hearing. So we did have a couple more tax-related questions come in. So I'll ask these before Gwyn jumps into all about the very interesting sounding IRS task force. And so the first one is, how does the interest from staking get taxed? And if that's something we need to save for Crypto 201, I have that written down already. So if we're able to get into that quickly, that would be great.
Yeah, we could probably save that one unless, Tim, you have a quick
I think this one we might already spoke about. As I said, crypto staking is much like earning interest. You get rewards for holding your asset and letting it power the network that uses a proof of stake, software. And but I think, especially if you want to know more of the specifics, I think that's more of a Cryptocurrency 201 topic.
Okay. So we know we definitely need to get into staking for sure. Also, will you receive a 1099 for crypto proceeds, or is this something that is all proactive on the crypto owner's end, that they need to make sure that paperwork is filed and the IRS is not sending you anything?
Yeah,
unless it's a letter.
Yeah, unless it's a letter. No, so right now, and I'll kind of get into this a little bit deeper, but just to give you a quick response, no one's going to issue a 1099-B like brokerage statement that you would get when you're buying and selling equities. The only 1099 form you may receive is the 1099-K, and that's just going to have what proceeds are on it. Those are the same forms that clients receive for their credit card transactions when they're running them through a third-party merchant. But there's some things in the work on the IRS where they are trying to get the brokerages to start reporting that information to them. So a 1099 like form could be issued.
Got it.
And I do just, and I'm not to cut you off, Gwen. The one thing I do want to piggyback on is the only brokerage, and it's, again, this is, we already spoke about Robinhood, their portion of crypto. They actually do provide a 1099, like as the question requested. But however, Gwen's 100% right. All the major online brokerages, wallets like that, they do not provide a 1099. They don't provide cost basis.
Got it. Okay, Gwyn, can you start getting into the IRS task force that I already mentioned that I think is very interesting?
Yeah. So just as a quick history lesson, kind of where the IRS has came from to sort of like where they're going. Obviously, cryptocurrency is a hot topic in the news. So obviously the IRS is going to get involved because, they're afraid they're losing out on tax dollars, on their end. This is similar to the actions they started taking, maybe 10 years ago on U.S. citizens that were stashing money in foreign accounts and not reporting that activity. So very similar as to how they ramped up policing that activity is how they're kind of policing, the growing activity for the cryptocurrency. But basically in 2014, was the IRS's first step where they issued notice 2014-21. And this notice was very basic and basically just said, any convertible virtual currency is going to be treated as property for income tax purposes, and sort of left interpretation kind of open. 2016, obviously Bitcoin's gaining in popularity. So the IRS decided, well, they needed to step up their enforcement. So what they first attempted to do is they issued this John Doe summons on Coinbase, which is one of the bigger brokerages that are out there. And the IRS, of course, was alleging that virtual currency gains, were either not being reported or were being underreported, and they wanted to obtain records to people who were participating in transactions that occurred from 2013 to 2015. Coinbase, refused to comply with them, and it resulted in this litigation up in the U.S. District Court in Northern California. And what the court did is it narrowed the summons and it granted access to certain taxpayers' records from Coinbase. So Coinbase had to turn around and give the IRS records for transactions valued at $20K or more during those 2 years. So the IRS got information that way. 2018, the IRS launched a kind of a virtual currency compliance campaign, and they also were creators of this Joint Chief of Global Tax Enforcement, which they've kind of dubbed the J5, which has 5 countries in it. So it's us, Australia, Canada, the Netherlands, and the UK. So these countries kind of came together in 2019, and they had a meeting, and they were sort of trying to generate leads off maybe some of the cryptocurrency offenders that were out there. Obviously, the people that maybe they identified during this meetings are going to be the people who are making substantially large transactions, on these blockchains, because they are public records, so they can see when, $4 or $5 million of currency is kind of moving back and forth, and they can sort of keep some records that way. So in the summer of 2019, the IRS took the information that they had gotten from their John Doe summons from Coinbase, and they started issuing letters to taxpayers. We believe that everybody who received a letter was somebody who had a Coinbase account. And there was 3 levels to the letters that were issued. There was the letter 6173, which required action on behalf of the taxpayer. And the letter basically stated is, you didn't properly report your virtual currency transactions on your income tax return, and you should file the delinquent return if you haven't filed, or you need to go back and you need to amend. If you don't report them, you're going to be subject to civil and criminal enforcement. So just like anything in the world, if you have tax gains and you're not reporting it and your tax liability gets up to such a large number, there's criminal charges that can be filed. It's more than just a slap on the wrist and some interest and penalties. So, there's some real consequences out there. The other 2 letters that they issued was a 6174 and a 6174-A. Basically, they were stating the same things in the 2 letters, just basically giving you notice where they think you might have been involved in cryptocurrency transactions, and you should really, review your records and make sure things were adequately reported. If not, you should amend. The only difference on the 6174-A letter was you don't need to respond to this letter, but just know we may send you some future correspondences, later in time. So just sort of a warning to people out there, the IRS kind of was clued in on maybe you were participating in some currency transactions. 2019 for a lot of people who are CPAs publicly practicing, this is the first time we saw the IRS asking a question on the 1040s, at any time during the year, did you receive, sell, send, exchange, or otherwise acquire interest in the currency? So we saw that, the question pop up on the return. In 2020, as kind of the pandemic started in March, the IRS reportedly invited cryptocurrency companies and advocates to a summit, and they wanted to discuss ways that the agencies can sort of balance taxpayer services with regulatory enforcement. So this is where I believe they started discussing, these 1099s that were going to be submitted and getting better documentation being reported to the IRS. in May of 2020, the IRS actually went out and made a public request for assistance from third-party contractors. And what they were looking for was somebody out there to provide, a consulting service to support taxpayer examinations involving virtual currency. And, they would assist in that by, calculating what gains or losses would be on their transactions and making sure that whoever they hired for this service would be able to testify at trial if necessary. So the IRS may have gotten some more records available to them to really start coming down, on the low-hanging fruit that's out there of people who aren't reporting. July of 2020, again, there were some news outlets that had reported that the U.S. cryptocurrency exchange were contacted by the IRS to get access to their blockchain analytics software, and that maybe a separately negotiated contract with another analytics company out of the UK had gotten involved with using that software, because together with the IRS and the Department of Treasury, it was reported that during a webinar that was in progress, that people were asking for guidance, on to address the third-party reporting requirements. So again, the IRS is moving towards getting these brokerages to report these transactions. When is it going to happen? We don't know, but it's definitely something that they are working on to get out there, just to make sure everybody's compliant. Because Uncle Sam always wants his tax dollars. And they have a fear, there's a lot of money that's out there, that they're not getting their hands on. So, and then again, in August of 2020, they sent out yet another batch kind of warning letters, very similar to the 19 letters, stating they have records and you didn't report your virtual currency transactions properly. So, go back and amend, review your records. And the IRS recently just was authorized to seek records from Kraken, one of the brokerages that are out there, and they're going after people who conducted at least $20,000 in transactions. So very similar to the John Doe summons that they had on Coinbase previously. So basically it boils down to, no matter how small your transactions are, the IRS is ramping up their enforcement efforts. They're starting with the low-hanging fruit first, the heavy hitters that are moving significant amount of money, and then they're going to start working their way sort of down the food chain as they get better processes and procedures and access to more records. So just make sure you guys are reporting your activity. While no one likes to pay extra tax, it's kind of a necessary evil of the world, just make sure you're reporting, you stay compliant so you don't get a letter and you don't get yourself into a mess that could have kind of been avoided if you just would have, checked the box and reported your small Dogecoin gain for the year. So
yeah, it really does come down to documentation. That if there's one thing and we want everybody to take away today, it's documentation. You need to do it. You need to pay what you're supposed to. So that was really helpful. I think we have one more question that has come in. What happens with the buying and selling of crypto pairs? So if this attendee were to buy Ethereum using Bitcoin instead of the fiat currency, what does that do? Aside from sounds like makes a lot of paperwork.
Do you want to take this one?
Yeah, sure. So there's a small calculation, and I couldn't more recommend, if that's the way you should say it, to use if you're into cryptocurrencies and you're swapping coins for coins and not just buying and holding. I couldn't recommend more using a third party like coin tracker, like some software that you're able to. It has a great API system. You're able to connect your hot wallet or your brokerage or connect what you want. And as Gwen said earlier, it's all retroactive. So if it's the end of the year and you're like, oh man, I should have got it earlier, it'll catch you up for the year, even prior years if you needed it to. And I wouldn't even try to keep, okay, this is my basis in Bitcoin. All right, well, that appreciated X amount. Then I swapped that for Ethereum and I paid this fee. But really, at that point, you have a gain on the Bitcoin or loss. So I would save yourself the headache, especially if you're into swapping coins and stuff like that. I'd pay the 60, 100, however, whatever level you need to prove. And there's a lot of really cool features other than just showing the gain or loss. I just want to kind of, on a closing note, I want to reiterate how important Gwen's point was on the wash sale rules, especially if you're moving large volumes of cryptocurrency. That's a really, with the volatility, especially of late, that's a really awesome rule to take advantage of. And talking with somebody like Brian, like, hey, Brian knows when to work with the CPA and say, hey, is there an opportunity? Maybe you have great gains in the traditional equities that, if you can recognize a loss from the crypto and buy it back, and you can recognize that loss and use it to offset the other gains, it's a really important planning tool. But to go back to the original question, I would make sure if you're in that level to use the third-party tracking softwares.
Mm-hmm.
All right. Well, last chance to toss in your questions for now. If you get this recording later and then have more questions, feel free to email info@corrigankrause.com or any one of our panel experts. Their emails are up now. I just really want to thank Tim, Gwen, and Brian for taking the time to walk through so much awesome information. And thank you to everybody that attended today. We're going to follow up with everybody with the recording. And if there's no more questions coming through, then we'll go ahead and wrap up. And we will see you all again for our Crypto 201, which will be taking place this fall. So keep an eye on our social media channels, particularly LinkedIn, for more information on that. And of course, right as I said that, 2 more questions came in. Is there any successful way to waive the late pay penalty if I filed all prior returns to report missing crypto transactions? Or is that just kind of late transactions?
The IRS has their first time abatement rules, so you might be able to get out of late filing on one of them if you can provide, kind of a reasonable explanation as to why it happened, but it's only a one-time thing that the IRS will offer. Other than that, you're going to be stuck kind of, if you're on a multiple years, they'll only give it to you on the oldest year. And then other than that, you're kind of on the hook to pay it.
And that's something that if you were to hire a CPA, they could probably help you walk through that type of minefield almost. And then second, we have any recommendations on crypto trading software. And obviously we are not endorsing anything. These are our personal opinions. But do you guys have any experience with trading software that you would recommend, say, to a friend?
So I think if you want to get your feet wet, I don't think there's a better way than doing Robinhood, PayPal, Cash App. Buy $10, see what it's like. Hey, I like it. It goes up. Maybe I want. And then when you start to get a little more advanced, I'd say the best intermediary would be Coinbase. Coinbase is a great way. You own your coins. You have your key. You have a little more access to maybe if you want to try a little more aggressive coin, a little lower cap, something that's not as well known as a Bitcoin or Ethereum or even a Dogecoin, that would be your next great place to start. And then something past then, you'd want to go to Binance or even a decentralized swapping exchange. But to reiterate, Robinhood, PayPal, Cash App, those are great ways to get some exposure.
Great. All right. Well, somebody just snuck right in with one last question. Okay, this really will be our last question. And anything else, please email us, like I said, at info@corrigankrause.com. And we will have another session. So this is, what about software for tax reporting?
Okay. And I want to reiterate Mary's point, first of all, that, that we don't really give, I can only speak to my personal situation. I use cointracker.io. It has a great interface. It's very easy to use. It's probably the most mainstream. So if you ever have any issues, they have good customer support, and there's usually online, you can figure out your answer if you have a question. But as I said, not endorsing anybody, I think it's a great software.
Great. So it really sounds like try a few things, see what works for you, and document everything. All right. Well, thank you so much, everyone. As I said, we have our information up there, and we look forward to seeing you all this fall. So have a great rest of your day, and we'll see you next time. Thank you.
Thank you.
Thank you, everyone.
Yeah, thank you.